Good morning, everyone. I would like to thank the Mexico Oil and Gas Energy Summit for this invitation, for this opportunity to talk before such a distinguished audience. My presentation is going to be a lot more technical than what Undersecretary Melgar said, so if anyone falls asleep, there's no hard feelings. I want to talk about how we approach the design of the contracts and how we ensure that we have a full competition in the allocation of these resources. First of all, a small reminder of what was the driver when designing the fiscal reform. First, what we look at when exploration and production projects occur. There's a part that is an economic rent, there's a part that covers costs, and what we aim to capture for the state and for the Mexican nation is the real economic rent that is created between the value of the oil and the extraction costs, including, of course, the cost of capital. And what we created with the fiscal framework is or it has a purpose of capturing in an optimal way, in a non-distorting way, how the economic rent is captured for the state. First, what problem we have? Well, you can look at the map. We have like 12, 14 different provinces with potential to, or gas and oil prone that have the possibility of producing hydrocarbons. However, these areas have a very different set of economic situations, different set of technologies that are needed to optimally exploit these areas. There are shallow water resources, which Pemex so far has very, very good at exploiting, but we have other resources such as tight oil in Chicontepec or non-associated gas in the Burgos Basin, Sabinas Basin. And this creates a very difficult problem for us. Why? Because normally what you see in other jurisdictions is that the fiscal terms are determined in the law and set through negotiations with the Congress. However, having all this vast richness and all these different type of resources makes for a very difficult problem to solve within the law. It is the set of economic terms for each different area is very different, and it creates a legislation problem because not each and every one of the different basins can be properly taxed. Now you can see it's different set of economics from a project that is 20 kilometers or 10 kilometers or even at the same location that that other project you can have resources that are one on top of the other. The quintessential example would be the shale oil and shale gas, that it is in some areas at the same location that we have conventional resources. This also creates the problem of how to measure and capture this economic rent. We have a different set of cost structures for different projects that move along different in time. Some may have a lot of economic rent, very economic projects, and that's where the Ministry of Finance would like to take a big bite on that rent. Others, like for example, non-associated gas, are very tough. Economic rent mostly doesn't appear on those projects, and that's because of the sheer nature of the production profiles. So before the energy reform, we had only Pemex, and it was just a matter of changing the change from one pocket to the other. So even though we taxed and we tried to include progressive elements and elements that did not distort the investment decision from Pemex, it was a very tough pill to swallow and very difficult to really measure how this economic rent was created. Not only because we only had Pemex, but also because Pemex was the sole buyer of a lot of the products needed for the exploration and production of this area. So we are facing a monopsony situation where the competition is very hard to achieve and come by. So first we have the problem that we cannot directly measure this economic rent. And second, we are not sure, or we were not sure, if the costs associated with the exploration and production of these areas were actually what we were observing through Pemex's costs. So the energy reform, what aims is to have a wide variety of players, a huge ecosystem of different operators, each facing, of course, particular situations in their areas, but where we can start observing also the creation of a set of suppliers that in turn will compete to offer the best costs to the companies. I think Lourdes Melgar gave a very good summary of this. I'm going to go through them very, very quickly. First, we designed the energy reform to set a broad and productive platform in line with current standards and practice in the international market, hydrocarbon market. We need to be properly benchmarked to ask for what other countries do and to be prepared to be as transparent as anyone in the world. This should be done through the direct competition and participation of the private market to have new players in the upstream activities using the new contractual regime that the energy reform provides. The execution of this work so far has allowed us to award 24 E&P contracts in the first 3 bidding rounds. We are currently on the 4th bidding round. And we still aim to have a lot more of players and suppliers in the value chains in this industry. Of course, to formally deploy this, we need to strengthen our institutions. CNH, the Ministry of Finance, the ASEA, the environmental regulator, the Mexican Oil Fund that I bet in a few minutes my good friend Mauricio will give a very good presentation to strengthen all our capabilities to really get into the core and view what it is important to create a framework of players and of new players and participation. And finally, this is not my core presentation, but also remind you that the energy reform provides for a full opening in the mid and downstream sectors. Now, the changes in the Constitution allowed for the creation of a very flexible fiscal system, whereas we can decide which type of contract we can choose to apply for a particular area, depending on the type of players, on the costs expected, and also on the attractiveness of the areas. So we have first a set of 4, let's say, broad type of contracts. The license contract that we have been experimenting with in the round 1.3 and now round 1.4, where we give full flexibility to companies to choose and execute how they are going to be doing their works. And also we have profit sharing contracts, production sharing contracts, where companies work more hand in hand with the National Hydrocarbon Commission, taking decisions together to provide for the best technical answers for the particular questions on how to better exploit a particular reservoir. From the side of the fiscal elements, production sharing contracts have a different set of conditions from a license contract. License contracts work basically as royalty tax systems, while in production sharing contracts we have cost recovery elements and the distribution of the net incomes from the project. Another decision that was taken very early in the design of the contracts is that we didn't want to get into negotiation processes, and that we wanted to be as transparent as possible when deciding who should exploit this element. So the reform provides for all contracts to be signed through bidding processes to create a set of simple rules to where to allocate the resources, and through this bidding system to determine which is the final fiscal burden. And of course also to align the incentives between the contractors and the government. Our E&P contracts are designed, well, just two steps back. Fortunately and unfortunately, Mexico is, in this aspect, a follower. We have been able to observe a very wide variety of different experiences around the world. We have the opportunity to take the best elements from each system and try to incorporate it within our framework. So we are able to see what the Norwegian licenses look like, how the Indonesian PSCs look like, how the Brazilian experiment with PSCs and licenses in one hand and the other has worked, and a lot of international systems. So we have been able to gather all these experiences, to gather all the elements, and try to make the best contract in terms of fiscal elements, trying to get the best conditions in terms of a system that not only provides for the government to extract as much rent as possible, but also to have a system that is fair for the companies, that offers them a reasonable return on their investment, and that ultimately aligns the incentives from companies and for the government. Here just a few qualities that the overall fiscal system has. Even though we face this problem, I explained that it is very tough to set ex ante all the fiscal elements and to have a definite fiscal burden on a particular project. We did indeed design in the law the basic elements that each and every contract should have. So first, we decided that every company is going to be part of the Mexican economy as a whole, so companies are taxed as anyone for corporate income purposes, for corporate income tax purposes, sorry. But also in the hydrocarbon income law, we define a set of basic royalties, surface rent, and conditions on how the payments within the contract should behave. Also, there's the mandate to have fiscal regimes that are progressive. This means that as the project gets more profitable, a higher proportion of this extraordinary profit should be for the Mexican nation, never trying to kill the project, of course. And within the contract, we create a set of rules of how the payments are going to be calculated, how all the records should be stated, and also we include a provision that states that if there are further fiscal changes, those should be compensated within the contract in order to guarantee a certain degree of fiscal stability. So within the basic terms of the contracts, what we have is corporate income tax. Companies that extract oil and gas are taxed just as any other company in the Mexican economy, plain and simple corporate income tax. Income less deductions times 30%, and that's the usual taxation. Obviously, given the nature of the beast, there are a couple of different rules for E&P. For instance, all the economic rent that it is created cannot be cross-subsidized with other type of industries. So for corporate income tax, E&P companies can just do E&P activities. You cannot cross the earnings from exploration and production with activities of retail, with refining, or any other activity. So 7-Elevens are allowed of the question. No. Also, taking into account that some of our projects may be developed within a short time framework, and that's what we are aiming for. We also recognize that there are a lot of projects where mature period is much more longer. Take, for example, deep water, where you can be investing for 4, 5, 6 years, very huge amounts of money without seeing a single drop of oil. So for corporate income tax, we have normally a carry forward period of 10 years of losses to be offset with future profits. In the case of deep water projects, these losses carried forward can be carried for 5 additional years. So based on our contract and the expectancy of these projects, companies will be able to deduct all the set of costs that they have been incurring from day one without the possibility of having stranded deductions along the way. Sorry. Also, for corporate income tax, you know, Mexico has a quite sophisticated system where everything the Mexican SAT receives the information is electronic. So everything for that part is exactly the same. E&P companies should present their numbers to the SAT as if it was any other company. You have to present all the reports as if you were doing any other activity with it within the economy. It's the same reports, the same set of rules. Now, the other element that is defined by law is the basic royalties. And these are constructed based on the premise that not all hydrocarbons are equal. Some are relatively cheaper than others. Some are fetch lower prices. So what this structure provides is a different set of progressive royalties for each and every one type of hydrocarbon, taking into account the realities faced within the contract. So, for example, we have the crude oil here, the crude oil royalty rate, where for the first $48.5 observed in price, the basic royalty is 7.5%. As the price starts increasing, the royalty gets higher and higher. So, for example, at $100 per barrel, the royalty is 14%, allowing the state to capture a higher proportion of the economic rent in this product. But I would like to point out that these royalties are set within the prices that are observed within each contract. So even though the Mexican mix may be on a certain level, if the area produces a much more quality oil, then the real price observed would be higher, and therefore taxation would be also higher. Notwithstanding, we recognize that there are certain projects such as very heavy crude oils that fetch a lower price, and then that is automatically recognized within the contract with a lower rate by having or recognizing a lower relative price. Also, there are rates for associated gas, for condensates, for non-associated gas, and here I would like to point out the graph for non-associated gas, whereas you can see that before the $5.5 price, there is no basic royalty. That is, as getting back to the earlier discussion, non-associated gas gets, it's very tough in economic terms, and we recognize that on those price level, it is very difficult to observe profits. So for non-associated gas, we don't have royalties for very low prices. Now, how does these two things add up? For comparison's sake, and this is just a very easy graph, we can see how the Norwegian system behaves, for example, which has a corporate income tax for oil and gas projects of 78% flat. So it doesn't matter the cost relationship in there, but they have a flat rate of 78%. That's the top line that it's in here. But we can compare also with Brazil or the US, that would be the most natural and direct competition for Mexico. So the basic terms, the two that I have mentioned before, make for the red line in the Mexico case. So we can see that in the basic elements of the contracts are quite competitive. We have a very lenient terms, basic terms, where we have a lot of space for competition within the bidding processes. Also, here is the bad news. We always have to have a progressive system embedded within each contract, as I explained earlier, as the profitability of a project raises, so should the proportion of the final profits that the government takes. Always we design these items always looking to not overbite and to leave the companies with a fair amount of compensation. And the mechanisms have been designed to kick in or to start biting when positive surprises arise in terms of higher production rates, greater amount of discoveries, or because the company is having better economic of scales. For the basic contracts, we have the PSC. What it modifies is the share that the government takes of the profits. For licenses, it increases the additional royalty that the contractors bid in the bidding process. So what we see is that for a certain level of profitability, this mechanism doesn't start working. When it starts working, it works on a very mild slope, so not to distort the economic decisions. And when we reach a certain threshold of profitability, there is a maximum rate. We don't keep on this progressivity, but rather we set a maximum limit where the government is going to be getting its government take. This is just for illustration purposes. It's not any contract in particular, but it is how the progressivity kicks in. So, for example, in the PSCs, you can observe that the government take, expected government take, floats around 20%. Once the profitability of the contractor, and this is after applying the adjustment mechanism, starts kicking in, the progressivity of the contract starts to work, and we have, as profitability is higher, greater chunk of profits are directed to the state. And this same behavior, a little bit more scattered, is observed also for our deep water license contract. This is due to the nature of each type of contract. One's are PSC, the other is a license that works on royalty tax. But this progressivity has, we believe, a lot of advantages, because if conditions change, this system is not sticky. What that means, it adapts through the life of the contract, and if, for example, there is an enhanced oil recovery project that demands a lot of investment, the adjustment mechanism gets back, so to allow for a greater share of profits for the contractor to pay for these additional investments. But also it guarantees, it not also guarantees an appropriate return on investment, but provides stability and certainty regarding the distribution of the profits. And this is very important because from day one, we decided that there was going to be no possibility to reopen the contracts and further negotiate with companies. The next 3 slides, I'm going to go through them very quickly because it's just quick reminders. In the PSC, what it is bid in the bidding process is the government share of the profit in terms of in kind, in barrels. We set a cost recovery limit that is 60%. For round 2.1, it is the same. But if we have non-associated gas discoveries, this cost recovery limit is risen to 80%. There's an uplift in exploration. On the ones that we have bid so far, the uplift is 25% for the exploration investment. And there's the adjustment mechanism. It's just a sliding scale where we recognize within this adjustment mechanism the risk incurred during exploration, so there is a multiplier in there to allow for the investment in exploration risk to be recognized. Then we have the onshore licenses, the 1.3 if you would like to call it. There we are bidding an additional royalty, and the adjustment mechanism works as a function of daily production. So this adjustment mechanism has the property of capturing additional profitability when production is high. If production gets lower as the profile gets less ambitious within the project, then we start scaling back the amount of taxation the companies observe. And finally, for deep water, that's what we are now in the middle of the process. The adjustment mechanism on the works on the additional royalty, and it has the nature of capturing net profits, not gross income, but rather on the net proceeds that are created within the project. Finally, we have all the contracts are allocated through a bidding system. Why? Because we believe that given all the uncertainties that the government has regarding costs, regarding production profiles, and regarding prices, can be or should be incorporated through market competition. Companies normally are better than the government to identify these opportunities, to identify the best technical solution, and therefore we should allocate the project to those companies that have the best qualities, the best capabilities to get the best costs, the best returns on their investment, and obviously the best share of the income that goes to the government. So most of the decision making within the bidding process is decided through a fiscal variable. Notwithstanding, we also recognize that investment is a very big part of deciding where a particular participant is serious or not. So increasingly throughout the different bidding rounds, we have been giving more and more weight to the investment variable in order for us to better capture who has the best technical capabilities, but also the greater commitment to really come and invest seriously in Mexico. So far, how have we done? Well, I think rather well. We have, even though the economic conditions in the industry have been very, very tough, we hear every day news about the price volatility, the difficulties that companies face in their balance sheet. Nevertheless, we have seen a very healthy participation, very healthy competition. We have allocated most of the contracts we have been offering, but more important than that, there's the additional commitments of investment that we are going to be seeing in the short term, and also investment for the long term. And this is going to be an ongoing process where we would like to be continuing these efforts through the guide that the Energy Ministry provides through the 5-year plans. So just as a conclusion of this and to remind you how this works, it's by law, we have the basic royalties, we have the corporate income tax. In the contract, we set the adjustment factor that is already set and known by each and every participant in the bidding process. And then through the bidding process, companies can decide how is the total burden that they are going to be facing through their bet on the additional royalty or the profit share that they will be willing to give to the government. All this add up to make the final taxation system for the contract, and that leaves the contractor compensation that should be aimed to recognize all the risks that they have incurred, and of course the cost of the capital that they invested to get that production. With this, I conclude my presentation. Thank you. I didn't see anyone fall asleep, and I'm open for your questions.
I'll give you all a moment to raise your hand in case you want to ask a question. In the meantime, I'll have one for you. If you would be hired tomorrow by a potential operator, you would give up your job in government. What would be your main request to the Ministry of Finance and to SENER and to anyone involved in the fiscal framework in order to change?
Well, that's a very difficult question, and probably I could be charged with trading with insider information. But I think that the very first thing that you should be looking for is to have long-term security, to have long-term stability, to have to be sure that the contract will be honored, that all the terms that you choose at the beginning are going to be respected by both parties, that the rules are not going to be suddenly changed within the time frame of the contract, and being open that these things can change, to avoid surprises, to be able to, whenever something arises, be able to sit and talk through them. I think that's the main issue that may be on the table.
So you wouldn't want to make any change to the actual fiscal burden that you would have to pay as an operator?
Well, actually, this is a self-taken decision. Companies bet what they think they are going to need on the gray side of the equation. If that is the size that they are willing to have, then so be it. If you bet that number, you live with that number.
Very good. Do we have any other questions? Well, I think you've done a very good job then. Exactly. Thank you very much.
Thank you so very much.